You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest, Senior Options Analyst and the author of the Options Playbook. So this week, I'm actually going to get a little wild and crazy here. We're going to look at a option strategy that is actually not covered inside the Options Playbook. We're going to do a strategy that is centered around a long combination, which is also known as synthetically long stock. And if you happen to have the playbook at home and you want to follow along with us, you can turn to page 76, and it's actually called a long combination. Now, we're going to do a little deviation from that, and we're going to look at a long combination that has some protection. It's going to look a lot like a protected put, but it has a lot of different features that are involved. And I've always, if I was going to update the Options Playbook, I always thought that I would add this one strategy, but long combinations are just an interesting way to get long stock anyways, if you have an expensive stock that you would like to go on in and trade. But I think with the market as pricey as it is now, every analyst that I heard talk on all the financial channels this week were extremely bullish, because of the tax reasons. They're saying the S&P 500 index is trading at 18-time earnings. It can trade more than that. There's just a lot of things going on. We got the VIX below 10. It's been below 10 about 5 or 6 times this year. That doesn't happen that often, and there's been 5 or 6 times over the last 6 months where the VIX is actually closed below 10. So there's a lot of bullish settlement in the marketplace, and there are some stocks out there that a lot of people are a little bit hesitant to jump in on, specifically the FANG stocks in general, Facebook, Amazon, Apple, Netflix, Google. Those are the FANG stocks. And obviously FANG with 2 A's is where that comes from, and it's been a big acronym lately on all the financial stations. So we're going to look at that trade. So we're going to look at this long combination, which is a synthetically long stock, and then we're going to buy some protection. So I just think it's an interesting way to get yourself into these stocks. So before I get too far ahead of myself, though, I promised last week that we would get a little bit of an update on what happened in our long calendar trade around earnings in Freeport-McMoRan. Now, we have the earnings date for Freeport-McMoRan is not until next week, so we have a little bit of time here for this trade to play out. And since we put the trade on, actually there's been more than one opportunity to close the trade. Right now, if I just look at the current quote on FCX, we currently have it at 1951. It's up 59 cents today. Yesterday, it was down about 59 cents. So there was an opportunity. You probably could have got out of the trade yesterday if you wanted to, and you would have made your nickel or dime profit. Because, as I said, before that first expiration, you're never looking to get a home run. But, we put the trade on for 25 cents. So a 10-cent winner on a 25-cent trade on a percentage basis is a big upside. So if you could have got out of the trade, you should have. There's no reason not to. But a lot of people might want to stick around just because they're interested in that earnings date. The market is actually doing what we would like if you want to remain long an option contract, a put option contract specifically around earnings. So the earnings date is 125, and the trade that we went out and put on, just so that everybody is on the same page, is we went and sold the 19 strike January 19th expiration put option, and we bought the 19 strike January 26th put option. I think we did the entire trade for a net debit to the account of 25 cents, and the market's actually kind of probably pretty close to that. If I pull up a quote right now, well, it's actually at the midpoint. We're looking at 28 cents. So you're up a few pennies on it because we've had some decay. But yesterday, I do know I got a quote on it, and you could have easily sold it for around 33, 34 cents yesterday with a little bit of the downturn. So you got 9 days remaining on that January 19th option. Once again, you could take that small gain if you wanted to get out, or see if that January 19th option expires worthless and just be long the January 26th option contract going into earnings. That option contract that we are long is currently trading at 52 cents. So basically, if everything stayed the same right now and the market did not move for the next 9 days, you would be long that 26 strike option contract for half price, basically, going into earnings. Okay, so now let's go in and pull up Facebook, and we're going to look at a synthetic long stock and one of the FANG stocks. I think Facebook is a good one because it's fairly expensive, but not amazingly expensive, right? And let's just talk about long stock, synthetic long stock, anyways, to start with. So we're going to go all the way out to June expiration, because what we're doing is we're trying to substitute long stock using option contracts in this scenario. And if we go right now and look at what Facebook did today, Facebook was very flat. It closed today at 187.84, and I should emphasize that right now we're taping Options Playbook Radio on January 10th, and the markets are closed. And as always, every strategy that we talk about is only meant to be educational. We're trying to learn here on Options Playbook Radio, and we just look for certain scenarios where maybe an option strategy would play in, but we never recommend doing these type of trades in general without understanding what's going on in your portfolio and your risk reward parameters. So with all that being said, if I go out to the June 15th expiration, when you're trying to build a synthetic stock position, what you're going to do is you're going to combine two trades. We're going to go out and buy a long call, which will give us unlimited upside potential, and then we're going to sell a short put, which gives us substantial downside participation in the underlying stock. So the long call gives us the upside. The short put helps pay for that call, but that all creates an obligation on the downside. So if you think about it, this is there's so many different scenarios that you can bring in when you're talking about a long combination or synthetic long stock, in that, it's very similar to selling a cash secured put. And if you're in a retirement account or you're looking at those type of trades, you're going to have to come up with the cash to buy the underlying stock at that put strike if you are assigned on that option contract. So we're going to throw a little twist into this option, synthetic long option. And we're going to actually, instead of just selling a put cash secured to buy the underlying stock, we're actually going to go and do a put spread. And I find it an interesting scenario in that when you are synthetically long the stock, you can easily trade out of the long call position if you are correct, and let the short put position just ride. Okay, so if the market was at 187.84, I would look to do something that is, very close to the money. And we're going to go out fairly far in time as far as the options are concerned. A lot of people don't look at longer term options, but we're going to go all the way out till June. That's 156 days. And that's the option contract that we're going to use. We're going to use the 19 strike option, which is the most at the money option contract right now. And to set up the synthetic long stock, we would buy the 190 and we would 190 call and sell the 190 put. And if we do that, we're doing this entire trade for a net credit to the account of 60 cents. So the market is at 190, and if the market went down, they would put stock to us at 190. We bring in a 60-cent credit. That means that we're officially buying this at 189.40. Now, if this is a cash secured put situation, that means that you got to have, if you're going to do this trade and you're legitly doing it as a surrogate for the stock or as a stock substitute, if you do this one contract by one contract in your account, you need to have $19,000 to be able to buy that 100 shares. Right? So 190 times 100 is the requirement of $19,000, but you're bringing in a 60-cent credit to the account if you trade this thing at the midpoint. And so you're officially buying it at 60 cents less than 190, which is 189.40. Okay. Now, here's where it gets interesting is if I'm going to add this extra leg and I'm going to give myself a little bit of protection on the downside here. So now we're selling the 190s, but if I am worried, I always like to look at, I don't like to lose much more than 5 to 7%. That's the William J. O'Neill number here, but I'm going to go a little bit more. So let's say we do a 10-point wide spread from 190 down to 180. So, if we do 10 points on a $190 purchase, we're talking about a 5% move. If you want to go 15 points, right, you'd sell the 190, buy the 175. 15 points on a $190 purchase price is about 8%. So you can decide where you want to go as far as what type of protection you want. But I'm going to go into this trade. We're going into earnings. We got a lot going on in Facebook. I'm going to buy the 180 put. Okay. So now if we do this entire trade, right, we're getting this entire trade done for a net debit of $7.43 to the account. So that 180 put does cost us some money. That was $8.10 on the trade. So if we're doing this trade, we're hoping that we can at least get that $8 and or we can at least get this total net debit back in appreciation over the life of this option contract. But why I like this long synthetic protective put, if you will, this long synthetic protective put is about the best way that I can describe it is the long call is your friend in this scenario. You want this market to start going on up, and you're going to get long that call option. And this makes it very easy for you to trade out of it in that I'm going to be selling a put credit spread that wants the market to go up. And then I'm also long this call option. So if I am correct on my forecast, and I get this entire trade done for it looks like $7.43 net debit to my account, if that all happens, I can just sell the call option and remain short the put spread if I'd like, once I got to wherever I'd like to be on that underlying trade. So I find this long combination, buy a put to go along with it, as a much interesting alternative than doing any protective put strategy where you're buying the stock outright, paying for the stock, and then you're just flat out buying a put option. And honestly, you're hoping that the stock goes up and it pays for that put, and you want that put to expire worthless. In my scenario here, I can trade that call option. When the market goes up, I can get out at any time that I want on it, and I can remain short that put spread, which I also want to expire worthless, and I can get into the trade that way. So on a lot of these expensive stocks, a lot of people are trepidatious to get in because they're setting new highs week in and week out. And this is one way that you can get into some of these stocks and give yourself some protection on the upside, and you decide when you want to trade out of it. All right. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. Thanks for listening, and we'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook was brought to you by Trade King Group. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to tradeking.com/ODD to review additional risks involved with trading options. Securities offered through Trade King LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.